If you're a woman in your 40s, 50s or 60s, you're probably sitting there with maybe the age 65 in your head as the magic moment you walk out of work for the last time. Good chance that number might be lying to you.
Yeah, and it's not because you've done something wrong. It's just because the whole system was built for a very different world than the one that we're living in right now.
Today we're going to talk about where the number or the age 65 came from and why it might not actually be a good fit for a lot of women specifically. And if you're a man sitting there wondering, well, why do I care about this episode? You're quite possibly living with a woman and you should care.
It's combined balances, guys. We look at you as a combined couple, and quite often there is some differences in the investment mix. There's usually one person making more choices than the other, but just the reality is that women have a longer life expectancy, so that means their income requirements are different than men, meaning they just need more at a later date.
Yeah, look, spot on. It's one thing to consider about sort of when you can retire and when the idea to walk out the door is. And, the government gives us all the same age, pension age, eligibility age, same preservation age for super and all that sort of thing. But the reality is the majority of women or the average life expectancy for a woman today is 85 years old. And for a man, it's only 81.
I'm not happy about that, Phil. I don't like that. I want to live longer.
You don't like it? Yeah. You get those last few years of peace and quiet at the end there. I don't know, but it's a reality.
Look, I think this is also a thing that I'm talking to my class a lot about is if we think 30 years ago, like let's say you're 58, 60, 65, whatever, right? Imagine 30 years ago, how different the world was to it is today. And let's fast forward to, let's say 25 years. Now that puts you at 85. Think of how different the world is going to be again. If Elon's talking about what's going to happen with the care robots, I don't think it's a hot take to say I think life expectancy will be pushed out even further.
Yeah, for sure. Yeah, that's right. I mean, you're sitting here now saying your life expectancy is 85, but by the time you get 85, yeah, you could well be into your 90s. There are a lot of unique things that women kind of face in relation to superannuation. Traditionally a problem for men. It's not just the fact that they're likely to live longer, but also you think, in our household's a prime example. My wife's had years out of the workforce at home with the kids, and that's pretty common. And like, we're really privileged and lucky that we're able to do that. It's great for her to be able to be at home, but that comes at a cost. And that's a common thing for a lot of women. They lose, and quite often in peak earning years, those sort of ages where they kind of are going up the ladder and that sort of thing. And then it can be harder to get back on that ladder later. So it lowers future income, or it can. So it's not uncommon for women to live longer, but have to do it off a lower starting balance.
So I'm just looking at the Australian Bureau of Statistics. The average retirement age for men in 2024, 2025, which is the most recent stats. Do you want to take a guess?
61.
For men, it's 64.9, which is a bit of a random one. So we'll call it 65 on the nose.
65, yep.
But for women, 62.7. Yeah, so it's about 3 years, two and a half to 3 years difference. And if you go and listen to podcast episode 2 episodes ago, we were talking about how those final 2 years make a huge difference to your retirement balance. That's quite interesting to say that that's what the real numbers look like.
Yeah, for sure. So what do you reckon? Like, what do you do about it? It's probably the question. Can't control how long people live.
Yeah. Well, I think we can talk from experience, right? So, like, how many families we've spoken to about this? I think there's a few things, the few key levers, and we're just kind of getting into it. We're really like, today's just kind of like an action podcast thing. I would say straight away more. I don't want to, are we going to deal in generalizations? I guess we unfortunately have to. If I'll see a husband and wife, it will be typically the non-working partner or the partner who earns less money has a more conservative superannuation balance as well. Which and this is just if you look at the differences here, we'll just put it on the screen. If you have a balanced portfolio versus a high growth portfolio, the difference between those two is going to be about 2% per annum, something like that. All right. So you might be getting, like last year was a crazy year because everything went up so much. But I'll put the numbers on the screen, and they'll be in the between 6s and 7s for a balanced and 8s to 10s for a high growth. And if you just turn the dial from one to another, it means you make more money. Asterisk, over a 10-year time frame.
Yeah. Yeah.
And if you are a woman who's 45, you've got a life expectancy, you're not even halfway at that point. You're only at the halfway mark.
Mm.
So you need your wealth to last for another 45 years. And just having that dial turned, or speaking with an advisor to make sure that you understand how a investment mix works, being prepared for ups and downs, because a high growth portfolio in the GFC did a minus 45%. So you had 200 grand a year. You say you had a super balance of 200 grand in 2007, and in 2008 you had like 108 grand. Pretty scary. As long as you can deal with those, and then about 2 years later it's back up. As long as you can deal with that roller coaster, you on the balance you have more wealth. But it's just being comfortable with that change. So that's my hot take, Phil. What do you do? What are your thoughts?
Look, I think, and look, I'll talk for a minute about couples. I mean, as a single person, this is a much harder challenge to solve. But if I'm talking about in terms of couples for a start, like I think, it's the sort of thing you should be planning for early. And I'm not going to tell people how between themselves as a couple they should be running their finances or anything like that. But my personal view, the way our household runs, my wife and I have been together. We've had kids. My wife's had time out of the workforce. In my view, that's an equal partnership. I was working, she was at home with the kids. That's both of us working, and we should be really moving equally together. So when I view our superannuation, it's one pot of money that's there for both of us. It's not my balance and her balance. And there's things that you can do. So you can start to look at, maybe through those periods while she's out of work, maybe you can do some contribution splitting. So I could start to split some of the contributions I'm receiving while I'm working over to my wife to equal out the balances over those years. Things like spouse contributions where I can get a tax offset for contributing to my wife's super while her income's lower, where she's going back to work part-time. But looking at things like your non-concessional contributions for government co-contribution, all these little things can start to add up. And of course, when you get closer to a time, there's all sorts of strategies we can do with withdrawals and contributions and stuff to equalize balances or something if that's important. But the reality is, as a household, as a family, you need to be planning for the fact that probably my wife is going to outlive me. And it's just that extra planning that, sure, we should be able to retire at the same time, but we need to factor into the projections that I'm probably dropping off the perch first. And, my wife still needs to be able to afford to eat and keep a roof over her head, which is important.
100%. So if you are a woman listening to this, you got to make sure that you educate yourself around market volatility, investing your superannuation in a diversified portfolio. You're not gambling it. You're doing it in a growth portfolio that's well diversified, that's professionally managed, etc. That makes a big difference. And like Phil said, just having that preparation, and I will go a step further, just saying, just talk to each other about it.
Yeah.
Like pull up your super balance and say, hey, what are you invested in? And like often people come to us saying, well, we don't know. So that's a planning conversation for maybe us or another time. But I like that idea of you guys both having the same investment mix. It makes sense.
Yeah, it does. There's a much harder problem to solve, or it's a different discussion, I suppose, when we're talking about single women, because, we don't have a spouse to start equalizing balances across and that sort of thing. But they still, even if you've been single all your life and we don't have kids and you haven't had time out of the workforce for kids or any of that stuff, the reality is the gender pay gap's a real thing. You've probably, on average had lower earning capacity out of your life, which leads to lower super balances, your career challenges, all that sort of stuff. So, and they're much harder problems to solve. But what it does mean is just be aware of the fact that, you are probably going to live longer than maybe you think, and maybe you need to start saving more earlier towards your super. We can argue all day about what should be done legislatively and probably what should have been done already, but we can't control that, right? So we just need to control what we can. So starting to think about these things and plan for them early is probably the best tip I can give there.
So I've got another one. If you have a sister, if you have a niece, if you have someone who's a single woman who's in her 60s, send her this podcast and we thank you. Be really careful if you are a woman in your 60s about Facebook ads coming at you with investment opportunities. We have seen over the past 3 years, women who are unpartnered, but they might have a partner, but not living together, something like that, and they've been effectively sucked into some. It's a high growth. It sounds amazing. It's this Facebook opportunity to invest in X, predominantly it's going to be a self-managed super fund setup, probably a property, probably some off-the-plan property, or maybe just something that seems amazing. Like it's like, the ads are like, it's low risk, it's high yield, you're going to get paid monthly. It has many masks, but effectively it's the same, which is, it's usually a property development of something that needs money. And so what they'll do is they'll hire a marketing agency to dress up an investment opportunity, put out a lot of Facebook ads, hire a sales team, have an amazing website, maybe have a podcast. And then they'll go into this kind of very complex structure that's quite hard to understand. And because it's almost maybe they've got to a point saying, look, I'm 62 or I'm 60 or I'm 58 and I've only got 200 grand a year. And this is my last swing for the fence and I'm going to have to take a swing. And you know what? I should have done more when I was younger. I haven't had a chance and they make me feel really empowered and I'm going to do it. So this is great. I'm going to invest in the thing. And then about 2 years later, they come to us and it's like, fuck.
Yeah.
So just be careful. Talk to your people in your world about those ones, about educating them about if it's too good to be true, maybe just have a think about it.
There's a reason that investing fundamentals are investment fundamentals and have been investment fundamentals for 100 years. It's because that's what works.
Yep. At the moment, anything above an 8% return carries a shitload of risk. Shitload. And it really shouldn't be even on the spectrum. Like if you're a high growth investor with a 10-year and you are 10-year time frame and you understand how it works, okay, we will tick those boxes and we can put a share focused portfolio that has that expected return profile, but it does have a chance of a minus 45%, one in every 20 years. But that's the worst.
Here's me anticipating the comments section again already. Yes, I know all of you sitting here that have been investing over the last 4 years have probably had 9, 10, 11, 12% returns, depending on where you've been. Great market cycle right now, not normal long term.
Yeah. Well, we did this. We did have clients last year with 20% returns.
Yeah.
Right. We had it.
Yeah.
But it was one in a 20-year cycle.
Yeah. Yeah. It's been great, but this is not long-term normal and things are expensive right now. So do with that what you will. But yes. So I suppose, look, just to wrap some of that up, that, yes, that there are some unique challenges that many women will face when it comes to retirement planning. And some of these, they are challenging to solve because the system is, for want of a better term, the system is in some ways stacked against them. So, plan for the fact that you are going to live longer than maybe you think. Plan for the fact that potentially you've had some time in the workforce and your balance is lower than where it needs to be. And seek good advice if you are one of these people that's sitting there. And like Scott said, we are talking generalizations, but we see it a lot. Older women that are a bit behind where they feel like they should be panicking and making some questionable investment decisions. Don't rush into anything, talk to a few people, use the advisor register to make sure you're talking to legitimate people, all that sort of stuff. And just plan for the fact that you're going to live longer is probably the main point there.
And I'm repeating myself, but if you have a brother, if you have a sister, if you have an auntie or an uncle, they're on Facebook and those ads are coming at them. So reach out to them, text them, just be like, hey, just be mindful about these things. Super important.
Yep. And if you're sitting here watching this and you're in your 30s or 40s or whatever, start throwing some extra cash aside now.
Well, actually, let's just touch on that. Let's say, for example, you're a woman who's 35-year-old woman who's listening to this podcast, and what would you be doing? I mean, it doesn't matter if you're a bloke, doesn't matter. So, what should we be doing differently to be mindful of that gender gap?
Yeah, like I said, I think definitely if you're a part of a couple, then it should be household planning, not individual planning. Like I say, everyone runs their finances differently, but really, if you're a couple and your wife's out at work looking for the kids, then it's a joint responsibility. So, that you need to plan that way. And if you're single, then you need to be cognizant of the fact that, okay, I'm only going to have my own bucket of money here. I may not earn as much as men in similar roles over my working life, and I need to prepare and put some more aside a bit earlier. But whether that's fair or not is a different conversation. Obviously no, but, you need to plan for it because it's a reality.
Yep. I'm also going to touch on around being very pragmatic around pay rises, and that's, I don't know, it's someone who's listening to this type of podcast is probably going to be more switched on to it, but ensuring that you are at the forefront of pay rises, ensuring that your resume is as sort of crisp as possible. I think that's a a thing that occurs where, 40s, that sort of 40 professional, there's sort of that delineation between the genders becomes wider, certainly on the income side of things. I also talk about insurance as well. Quite often we'll have blokes coming to us with life insurance pretty well organized, income protection normally okay. So they've got that backup plan there as well. But again, women tend to, I just don't know. I just don't think it's been spoken to them in a way that's clicked. What do you think?
Yeah, look, it's an interesting one because quite often I'll see, particularly younger couples, maybe they've got the mortgage or whatever, and maybe the wife is at home looking after the kids or working part-time looking after the kids. And there seems to be this view of, well, my husband's out. He's the one that's earning the bulk of the income, and that's what needs to be protected because if something happens to him, we're in trouble. But everybody magically forgets about there is it's a big workload being at home, looking after a household, looking after children, right? If something happened to my wife tomorrow, I'm screwed. There's no way in hell I can look after a 5-year-old and a 7-year-old and work full time and study full time and do all the stuff that I do now to keep money coming in by myself. It's impossible, even though my wife is back at work full time and all that. But when she wasn't, we still needed to have provision there. So if something happened to her, there's a significant financial cost there because I need to get help.
So what we're saying is, I would say, total impairment disablement. Make sure you've got it at a level that you're comfortable. We have an assessment that we take our clients through to assess debt levels, expected future income, and then the protection, the downside to match those two, so they're basically neutral. And I'll just touch on this as well. There's really only 8 life insurance companies in Australia. And there's like 12, 15 different brands. So it's kind of confusing. It's a bit of a mess. Compare the market type businesses will have like 4. So that's a bit dicey as well. You can usually just call your existing super fund, talk to them about upping your existing insurance levels. That's probably a good spot to start. I'd touch on that one.
Yeah. And just while we're on the topic of insurance and talking about families and that sort of thing, a lot of people are aware of it. But if you've got like a life insurance policy or a critical illness trauma policy, something like that with most of these major insurers, they will give you the option to tack on to that what they call child cover insurance. And it's usually really, really cheap. I think I pay $20 a month or something each kid. But that then pays out a couple $100,000 if, God forbid, one of my children is diagnosed with a major illness of some description. And I've seen it. I've seen it happen. I've seen people, young daughter diagnosed with cancer and lose their house, because obviously in that moment, all your focus is on your child's health. So, that's something else just to consider. Most people aren't aware of. And if you're one of those people, check it out.
This subject's is a little close to Phil's heart, I know. So I'll just go and drill down. So, in not that scenario, but a completely different scenario. I think she had an 8-year-old daughter who was like really got cancer. So mum and dad were in their like 40s and still had a home loan, but obviously the whole focus needed to be on the children at that point in time because they didn't know if she was going to be around. So then the house was sold and all surplus money was basically just put into the care of the child. And financially they were obliterated, but they managed to get through it. And a child care insurance policy would have enabled them to have gotten through that with keeping the house.
Yeah. And it just means because, if one of my children suffers a major illness, no insurance company's paying me out for that. No insurance company's paying my wife out for that. So we've got to keep working and going on with life like normal. But if we've got that pot of money, it means we've now got the choice. We can get the best medical care we can find. My wife can take time off work to be at the hospital and all that sort of stuff. So, anyway, it's not something you're aware of, something to get aware of.
Yeah, and insurance is a bit icky as well. But so it's one of those things you should just have it, leave it on a shelf, make sure it's there. Sort of. So I'm just going to do a recap of what we've spoken about today. There's time out of the workforce element. There's a contributions gap, and that can be resolved by contribution splitting, having the conversation with your partner. You're on the same team. You're just doing different roles. Yeah. Ensuring that the insurance is organized, not just the default settings, not just forgotten. Phil, risk profiles.
Yeah, look, there is often a mismatch, and often having less super than you feel like you need to leads to 2 kind of worrying behaviors. It's either causes you to be super cautious with it and take too little risk, or it causes you to panic and do something stupid. So have a conversation with someone that can give you the right guidance there is probably the important thing.
Yeah. Great. And that's basically the topics we're going to be talking about today, rolling into next week's podcast and rolling into Christmas. I'm going to ask your questions. If you've got any questions you want us to answer, please send them over. We are watching the comments, so if you can put them in the comments, that'd be great. We're going to end the year, Christmas 2025, with Scott and Phil's hot takes for 2026. So if you've got any thoughts on what you'd like us to discuss on the pod, we will be talking about it, and I'm going to give you a preview. It won't be like crypto, which we've just kind of forgotten about, but I think it'll be way, way less. You're not going to have 2/3 of the public workforce out of jobs or anything like that. I don't think that's going to be the case.
No chance.
All right. What do I feel? What do you want to be talking about in the December pod? The questions that we can be getting in.
God, I don't know. You threw me on the spot there. I haven't even really stopped to think about it. I haven't thought about what I'm doing tomorrow yet. Probably more property market chaos.
Yes.
I don't think that will be overhyped. I think we'll be sitting here and it'll still be chaotic.
Yeah, I agree with you. All right, guys. Thank you so much for listening. Good pod. We'll see you next week.
Cheers. Thanks, guys.